Hi, Michelle Kay here, and I'm with my friend Susan Kievman. And what she sells is, I'm going to call it reverse mortgages, Susan, for lack of I'm not very educated as you are. So if you could tell people how the services you provide and yeah, explain to them what you do.
Well, I am a reverse mortgage specialist, and of course, I offer traditional mortgages for people living in their homes who want to draw cash out. But a lot of people are not aware that 4 years ago we came out with a program where you can purchase a new primary residence that you're going to live in with what's called a HECM for purchase. What it means is home equity conversion mortgage. And it's an opportunity for someone who to get into a new home, downsize perhaps, and with very minimal qualifying. We don't care what your FICO score is. Your income really isn't that important to us. But you can get into a new residence, have financing that is financed by the reverse mortgage company with no payments as you move into your new residence. So you can save a lot of money over your lifetime not having to finance a mortgage. And there are no payments required until you sell the home or pass on, obviously, and leave the home to your children at that point. And how it works essentially is that you have to be at least minimally 62 years of age and older.
Okay.
You need to be living in there as your main home. And we're going to finance approximately 50% of your home purchase.
Okay.
So that means that if you're purchasing a $450,000 home, you're selling another home and coming away with maybe,
$450,000.
let's say, yeah.
Right.
You can buy that $450,000 home for about $225,000 down.
Okay.
The rest is going to be financed in a reverse mortgage, and you will not have to worry about making a payment or worrying about ever being foreclosed on or any of that kind of nonsense, because it's FHA insured, non-recourse. The house still belongs to you. You can pass the home on to your children, and it becomes their property, and the loan's not due and payable until that happens.
So the amount that you can get out is based on the value of the house and also your age.
And your age.
So you do have to come, like we're saying, if you can get 200, I look there, 62 years old, 200 and say $30,000. So you'd have to come in with the difference between that and the purchase,
correct,
purchase price. So it wouldn't make sense. You couldn't take a loan out for a portion of the price you have to finance.
You can't take the loan out. You either have to have the cash in
Right.
some type of savings or investments,
Okay.
or it's going to be contingent on the sale of your house because you're going to be walking away with profit from that, or from FHA gift funds.
Right. So we're saying a good story, a good illustration would be somebody who would raise their children in a large home. We just had a woman come through this open house and no longer wants that larger home and is just going to move into something smaller and less expensive. She's going to walk away with equity. So instead of putting all of her money into the house, she can keep some of her cash out and just have this more. And
we all need that money for latter years. Lots of stuff comes up.
Yeah.
And it can help with your retirement savings and etc.
Yeah, all right.
The other thing that you need to know is that if you're moving into a condo or a townhome, you're responsible for your taxes and your insurance and your HOA dues.
Okay.
And that the condo and townhome has to be a FHA approved building.
Oh, it does have to be FHA approved.
If it's a single family dwelling, all you have to worry about is your taxes and insurance. You take care of those, and you can live there for the rest of your life.
All right, very good. Okay, Susan, we finally got this video together, and I've learned something, and I hope that my people who watch my videos do too.
Okay, thank you so much, Michelle.
All right, take care.